So you guys remember in the campaign trail, candidate Donald Trump rhetorically, or maybe not rhetorically, kept telling crowds, hey, you're going to get so tired of winning, you'll say, stop it, I can't take it, stop it, I can't take it. Well, guess what? Today, that theory was put to the test because the stock market actually had difficulty maintaining gains after a series of amazing economic data. I mean, we saw the private sector, the ADP jobs report, 230,000 jobs. Wall Street thought it was going to be 180,000. Then there's the North American Class 8 trucks. I always talk about them, up 92% year over year, 200% from the year before. Then the non-manufacturing, the service sector of the economy came in significantly above Wall Street consensus. Here's the thing, the employment part hit an all-time record. All of this winning caught up to the stock market. The 10-year yield tickled up to 3.18, knocked the wind out of the rally. The Dow gave up 100 points. The S&P actually slipped into the red for a moment. So let's take a look at where the rally goes from here as these growing concerns of too much winning, too much giddiness maybe comes back to haunt it. Brought back Shah, Gilani, and David Nelson, two of the giddiest, happiest guys I know. All right, Shah, let me start with you. The yield. Because remember February, people don't remember because I think the headlines have people confused that tariffs didn't hurt us. I think it was in February, 3 of the 4 worst days of this year. 3 sessions, 3,000 points, all as the 10-year yield was approaching 3%. Well, we're way over it now. Everyone was scratching their head. When did we get to the point? 3.18, boom, stocks went down. Is that the number?
Stocks were up today. After, yes, they sold off a little bit, but they still ended up on the plus side. You recall February, it was horrible because what happened is they went over 3% for the first time, and that was on the January jobs number, which was wage gains about, I think, 2.9%, right, which was, unexpectedly high. So I think what happened today with the yield at 3.18, touching at 3.18, it ended a little lower. I think the market digested that beautifully. I don't think the yield's going to be a problem. I don't think the Fed is going to be able to raise rates enough. And they're not going to be able to move the Fed funds where they're talking about moving it to. The market just won't allow it. The banks have too much money to lend. I don't think the interest rates are going to be a problem.
Nelson?
I think it's an issue for sure. Look, I think the biggest fear that's in the marketplace right now is that will the Fed make a policy mistake? That's always the fear. I have a lot of confidence in Powell. I think he's being pragmatic, and I think he's noticed that, inflation is targeted at 2%. Expectations are pretty good right now, so I don't think they're going to overdo it at this point. If there's a risk out there, it's not in this country, it's overseas.
Let's talk about market breadth, okay? We see the big headlines, but when we look under the hood, it is a little disturbing, right? New highs versus new lows. Many more stocks are making new 52-week lows. On a lot of these sessions when we're up, there's more down volume than up volume, not many more advancers than decliners. The breadth is kind of worrisome. A yellow flag, red flag?
Not for me. I think the breadth is okay, and a lot of the breadth that you're seeing is hidden because a lot of it is being bought by these the ETFs and the index funds. They're bringing up a lot of stocks that otherwise wouldn't be going up. So I think breadth is okay because of that. The stocks that aren't doing so well are outside of the major indexes, outside of what the ETFs are packaging, and they're the ones that are suffering. Why? Because they don't have the earnings to produce. So they're suffering as well. They should be.
I think the turmoil you're seeing is the change in leadership right now. It's not just the secular growth stories that are working anymore, the Amazons, the Facebooks, or the Googles right now. You're looking into the industrial sector. You're seeing sales growth, something we haven't seen in a decade.
Are they big enough, though, of the overall market to lead
in mass, they are, sure, but it creates this huge turmoil. You saw over the last two days this big unwind of the fear of a trade war out there. And that's why small caps got hit so hard.
So let me ask you before we wrap it up then, guys. What are you worried about, if anything?
I'm worried about mechanical failure. And by that, I mean something happens in the market whereby there's some, fat finger somewhere, sets down, a couple 100,000 S&P sell orders. That triggers ETF selling. That triggers the mechanics that I'm worried about. Fundamentally, I don't have any worries.
For me, it's overseas. I look at credit default swaps and a sovereign debt of a country like Italy. It tells me something's wrong over there. In the end, emerging markets and developed markets, they're our customers. 40% of S&P revenue is international.
So ultimately, we don't have a moat. I mean, we do have a moat, but it's still
we don't live in a vacuum.
Impenetrable.
We are pervious to what happens outside.
But both of you guys overall bullish, at least for the rest of the year.
I'm long.
Yes, absolutely.
Right. That makes 3 of us.